and some of the things that transpired there. As always, I'm joined by Chris Paris, our Chief Investment Officer, and we're going to have a special guest tonight, a new member to the investment team, and we're going to bring him on for the last 20 minutes or so and get into a little bit of his background, some of the value that he brings to the investment team. So we're going to try to pack all this in, and we're going to try to keep it to an hour. Sometimes it goes a little bit longer, but we look forward to going through this information, and we have some pre-submitted questions as well that as we go throughout the discussion tonight, we're going to pepper some of those in. And the goal tonight is really to spend a little bit of time, again, just focusing on what happened last year in 2022, because that leads into 2023, obviously. Focus on what we feel is going to happen in 2023 based on the economic data and some of the most important kind of turning points that are upcoming that we're anticipating along with a lot of the investment world, and then get into some of your questions here and introduce Charles, the new member to the investment team. So Chris, how you doing?
Doing great. Doing great.
Glad 2022 is behind us?
Oh, yeah. I think everyone is. Except for maybe Ken Griffin at Citadel. So.
Okay, so we just want to jump right into this. One of the things you and I talked about, because no matter how long you've invested money in the markets, institutionally, on the retail side, even if you're doing it for yourself, there's always an opportunity to learn from the things you did right, the mistakes that you've made, how the markets react to economic events. So I want to start this discussion with what you learned in 2022, because it really was an amazing year when you look back at the historical significance of what happened. So what happened last year to your 60-40 stock bond portfolio was, so I don't butcher these numbers, 17 at the end of the year, so based off the 10-year treasury, so United States 10-year treasuries and the S&P 500, if you had a 60-40 portfolio, that was down 17.5% last year. So you have to go all the way back to 1937 to see the combined 60-40 stock bond portfolio perform worse than it did last year. So many people consider bonds to be a position we go to for less risk. And they are less risky than stocks, but it's important to understand that bonds are not 100% safe. And I think last year was made it pretty clear that bonds have a lot of market risk as well. And to see the 60-40 portfolio lose 17.5%, I think was shocking to a lot of people.
Yeah, it was definitely shocking to me. I mean, Troy has the stats. They're up on some prior videos of ours. I think the main thing about last year that was so different is that stocks went down considerably and bonds went down at the same time. I think bonds were down 3 times the next closest negative year. So there was no ballast to your portfolio as far as bonds go. What did I learn last year? Been doing this almost 30 years, and cycles are the same, similar. They rhyme. Last year was something I'd never seen. It definitely was unprecedented in my career. Troy has the stats. It's unprecedented for the last 90 years. And a lot of that is because of what the Fed and what our government did to get us out of COVID in 2020 and 2021. We had a great party in the markets during, for about 12 months, 18 months, and we had the hangover last year.
So just to kind of recap, because it's important to have context to what really transpired last year, and we have to go back to 2020 and really 2021. And one of the terms I think we're going to kind of come back to frequently tonight is the concept that markets are anticipatory. So we did a video back kind of, I think, March 23rd, March 24th, like right in the grips of COVID with the market decline. I think it was down somewhere around 40% at that point. And we had a video where we talked about, I think it was the 4 S's. I think it was the 4 S's, where we talked about signs that we were starting to see that the market we felt would recognize, and how the markets respond proactively, leading before the economy actually starts to pull itself together. So the stock market always performs before the economy actually gets better. So I think it's important to have some context that in 2020, when we were in the middle of all that and it felt like the world was ending, the federal government, Congress, as well as the Federal Reserve, both jump into action to start to fund essentially the economy and the stock market. So it created these bubbles that started it really in 2020 and lasted through 2021. So now we get to 2022 and I guess kind of take it from there in regards to what the Fed did up to that point as far as maybe not acting quickly enough, but then also trying to catch up and really get really aggressive on the interest rate.
Yeah, so I mean, they overdid it in 2020 and 2021, and we had seen signs of it when we wrote our outlook for the first half of 2022. I think we titled it "Curb Your Enthusiasm." We were expecting our first correction. We were not expecting, our first bear market in years. We didn't expect the Fed, to take interest rates from 0 to almost 4% in 9 months or something like that. So, they decided finally to start to tighten the screws and reverse course, and it's caused a shock to the system. Luckily, most of the main parts of the financial markets that we operate in the retirement space, bonds, stocks, have actually kind of started to settle down. They obviously created a crisis in the cryptocurrency market where there's been a lot of liquidations and bankruptcies. We don't operate in that space, so we've missed that. And hopefully everyone looks for a crisis event when the Fed tightens monetary policy. Hopefully that's the event, because the banks are in good shape as far as their balance sheets. We just need these waves. We had a huge wave up in 2020, in the first half of 2021. We had a huge wave down in the first half of 2022. And now we're just we're trying to find what the median's going to be. We're trying to find that glide path forward.
So to kind of focus in on maybe the biggest lesson from 2022 that you learned, what would you say that is?
I always have a lot to learn. I mean, I'm 57. Hopefully I'll be doing this for another 30 years. I'll learn more lessons. That stocks are anticipatory, right? And if you see something and you think something is going to happen, go ahead and make some change. You can always change your mind. It's best to take some action in advance, because you can always reverse course.
Because we saw a major shift in the types of stocks that really performed relatively well last year versus what has transpired over the past really 15 years, going back to 2008. So growth stocks have led the way for really the past almost 15 years. Let's call it 14 years. And then last year we see the Dow Jones lead the way significantly, outperforming the NASDAQ. So we've seen a little bit of a transition from growth stocks to companies you find more in the Dow Jones. So coming into 2023, I guess the first question I want to ask is, with the NASDAQ really leading for the first few weeks of this year, I think outpacing, I think I saw the NASDAQ was up about 8% year to date, and I think the Dow was up around 2%. Do we see this as kind of a fundamental shift going back to where we were, or is this something that's kind of temporary, or where do you see this falling?
Yeah, so we run diversified portfolios here. Last year we were barbelled. We owned a lot of more boring stocks in the consumer staple space, the beverage companies that everyone can think of, some drug stocks. And then we did own some technology stocks that took a beating. We owned some industrials that were more value stocks that held in there pretty well. Year to date, if you had no history with the stock market in 2022 and you looked at your portfolio today, you'd think it's a bull market, right? Growth stocks are leading. They're beating the S&P, I think, almost 2 to 1. They're probably beating the Dow 3 to 1. It's been a reverse almost to the day of what transpired in January of 2022. I don't see this. It's not back to the go-go years of growth stocks are up and to the right for the next 10 years. Interest rates are going to stay higher than they were for the last 15 years. The Federal Reserve clearly wants to get interest rates to 4.5 to 5.25%. They say they want to stay there. The bond market says they're not going to stay there for very long. I'm not going to fight with the Fed. I'll go with the bond market. But even if interest rates do continue to come down, if inflation comes down, if real interest rates come down, which is that premium of risk that you pay, that you get paid to own a bond, even if that starts coming down, growth stocks they'll do a lot of catching up. And we've seen, the technology stocks, the semiconductor stocks just roaring, and they're firing people, right? They're laying off tens of thousands of people. You'll see those continue to start to work this year, but I don't think it's a regime change back to the good old days of FANG and FANG only. You're going to still want to have a diversified portfolio, want to have some growth, want to have some more value stocks, cyclical stocks, definitely dividend stocks to give you some income and to hopefully reinvest and compound that money.
So, it's important, I think, to discuss what we've seen so far this year, because I know we've been talking to a lot of clients about the 2023 is not going to be linear in regards to the rebound coming out of what we just went through in 2022. But we also have been a bit defensive because when we look at part of last year and the end of the year, protecting some of the companies that had gains that we wanted to lock those in, but then also positioning the portfolio for what could happen in 2023. So when we start to look at what you mentioned there, real interest rates. So real interest rates, when we're looking at the forward inflation expectations combined with, or the difference between forward inflation expectations and interest rates, if we talk about, let's say, the 2-year Treasury. So the difference between those two, what the forward-looking inflation expectation is and the 2-year Treasury, we kind of get that real interest rate. So when those start to come down is when your growth stocks start to perform. And what we've seen really is the markets coming to grips with the Federal Reserve, most likely a 25 basis points hike now, a 25 basis point hike in a couple of the next meeting. And they're also starting to see interest rates inflation stabilize on the out 3, 4, 5 months. So we have these forward-looking inflation expectations that are somewhat under control based on the data, along with the Federal Reserve slowing down the interest rate hikes. So now we've seen the real rates actually start to come down, and this has kind of fueled the rally in the beginning of the year.
Yeah, we've done numerous YouTube videos on inflation. We're doing them last year. We try to follow the real-time data, not the government data. Government data lags. They're going to keep looking at it. They want to. The data we look at, inflation peaked in June of 2022. Goods data peaked. Goods inflation peaked. It's coming down fast. In fact, a lot of the consumer staple companies just reported earnings, and pricing was up, but units were down year over year, which means, they've raised pricing so much that they're destroying demand. So that pricing is going to start coming down. You see it in the supermarket in the meat section. Most people who watch these videos know I'm a big barbecue guy, so I'm happy ribs are $2 a pound now.
The office is pretty happy too.
Yeah. I try to feed people sometimes. So real interest rates peaked in October, and they're starting to come down. They've broken 15-month trends, and as soon as that happened, I think we did a YouTube video. As soon as that happened, the computers that trade this stuff, they buy baskets of technology stocks, even though they're laying off tens of thousands of people, right? Microsoft just announced layoffs. The stock goes down. The stock goes up, the stock goes down, and the next thing you know, it closes up 3 or 4% the next day. The semiconductor companies are doing the exact same thing. And the reason that happens, and this is something I have to relearn time and time again, is companies, your stocks, care about the marginal cash return that they generate. Every dollar that they generate, whether it's an energy company, a tech company, a healthcare company, the next dollar they get, what do they do with it? Do they hire someone? Do they spend it on equipment? Do they give it to you as a dividend? Do they buy back stock? What do they do with it? And the market is super smart. They see it in advance. They see Facebook deciding to spend $15 billion, a year and a half ago when things were great. And the stock may keep going up, but it starts to underperform the S&P 500 because they know we have no idea what this $15 billion investment's going to return, a year, 2, 3 years down the line.
So the marginal return on that invested capital, if it's diminishing, the market starts to discount that almost immediately because the market is a tremendously efficient mechanism when it comes to valuing future cash flows, and not only that, but risks as well.
Yep.
So, okay, so it's interesting. I want to put a cap on 2022 here, because when we were providing context there, one of the things I know we wanted to talk about was the let's call it the Fed-induced recession, or the Fed-induced inflation, kind of both of them really. Yeah. And we saw tremendous peak in demand for goods once everyone was at home in 2020 and 2021. We had all the stimulus from Congress, but also the Federal Reserve lowering interest rates, which led to a tremendous stimulation in demand for goods. Once people started to leave their houses, all of a sudden that demand for goods subsided and demand for services increased. So we talked a little bit about this. Can you just expound a bit more on how that impacts the market and the economic cycle that we're in now and probably moving forward in 2023?
Well, yeah. So America is 75% a service economy. We're only 30, 25% goods. So the service component of inflation, it's peaked, but it's wages, it's housing prices, it's rentals. It's slower to come down than goods prices. If Peloton orders 10,000 too many treadmills, they pile up and they mark them down $1,000. Companies in the service industry, they hire slowly, they fire slowly. They don't want to make those changes. So it'll roll through the economy at a slower pace. The Fed is looking at unemployment trends or looking at wage trends. We've done some YouTube videos talking about the employment numbers aren't what you're seeing published in Bloomberg, on TV. The BLS data that comes out that's touted as 250,000 jobs, those really aren't great jobs. If you work the data, they're part-time jobs. They're people working multiple jobs. So we're trying to get the economy back to, as we've titled it, the old normal, where we're a very old economy. We're a boring economy. We should be growing at 2 to 2.5% a year, plus some inflation. We took it up to 8 or 9% after COVID when they were writing checks to everyone. We went negative in the first half of 2022 with negative real growth. I don't think we have a big recession coming. I don't even know if we have a recession coming. It's not my job to figure out if we have a recession. It's our job on the investment team to figure out how to position the portfolios for sustained growth, for sustained income for our clients.
And getting back to the anticipatory comment from earlier, which we'll keep coming back to, the market doesn't care if we're in a recession or if we're going to be in a recession in a month or two. The market cares about where are we going to be in 6 months or 12 months. So you'll see, if you go back and look at the data historically, the market always bottoms typically before we in the economy actually know that it's a recession. And the market is one of the first things that pull us out of that, and that's why it's really a leading indicator when it comes to where we're at economically. So just to, again, one more time to wrap a bow on this, and then we're going to get into the first half outlook. By the way, after the video is posted, we will have Chris's entire link to, he did a 2-part video series on the 2023 first half outlook. It's going to be a condensed version with not as much discussion and context as we're going to have here, but it's going to have more charts and graphs for those who like charts and graphs. So one of the big things the Fed has been looking at is obviously inflation, and inflation is dictating their decisions with raising interest rates. The service component of inflation, since that has lagged beyond the goods aspect, we're starting to see these layoffs now, and we should see that put some type of damper on wage inflation, no?
Yeah, yes, it will dampen wage inflation. Right now, the data that's coming out, it's actually really good data for workers, because these tech workers are getting laid off and they're getting very big compensation packages. So the layoffs aren't showing up as a decline in wages yet, but behind the scenes, some of the other employment data we look at are showing average hourly worked is going down. The dollars people are getting per hours are starting to go down. And the leading real-time indicators are starting to trend lower, which is good, not for workers, but good for investors, because what you want is you want the Fed to exhale. They were late to raise interest rates. In fact, if you probably want to follow a leading edge central bank, Canada was one of the first central banks to raise, and then they raised 100 basis points mid last year. They just raised by, I think, 25 basis points and said, we're pretty much done for the year. They've actually been ahead of our Fed this cycle.
So we see on the forward-looking data, inflation definitely getting under control. So when we start to talk about how does this relate to your portfolio as we transition into the 2023 outlook, one of the questions that came in is Troy, if we know we're in a recession or going to be in a recession, why are we invested? Why do we still have any money whatsoever? Well, the simple matter is we don't know that economically, if we do contract, if GDP contracts 2 consecutive quarters, technically we're in the definition of a recession, but it doesn't mean the stock market is going to trough next week or next month. So having that barbell approach that you talked earlier with the portfolios where we're still balanced across the economy, but we own companies that if a recession does come, we feel they'll be more resilient with regards to the revenue and margins. But also we're positioned where we still have companies that we feel have been discounted significantly, but are more technology names. And we think they're actually great bargains at these prices. So when we look at that question, why are we still invested or why aren't we in cash? It's because these things can, one, they can shift on a dime, but two, every single one of our clients, every single one of you, we have the money invested according to a retirement plan, according to an income strategy, according to a tax plan. And we know based on your income needs how the money can be invested because where you're going to get that income from. We don't ever want to have too much money at risk in a situation where you're going to have to pull from that right now. So not only can markets change on a dime, which we've seen really at the turn of the calendar year where tech stocks have just taken off and your more value-oriented stocks have slowed down, we have an investment strategy that's part of an overall plan that's designed to provide income, help reduce taxes, along with the other aspects of the plan.
Yeah, I think there's some data in one of our podcasts that talks about in 2022, I believe it was only 5 trading days accounted for 95% of the entire decline in the market from the peak to the trough. 5 trading days out of, I mean, how many trading days is the market open, Charles? Almost 200? 200. If you're good enough to miss those 5 trading days, please call us. We will hire you. We'll pay you probably a lot of money, and we'll promote you too. I mean, that's impossible. You'd have to sell everything or most everything well in advance and sit on your hands and then turn it around, in October and start to buy everything back. So we're not that good. But
okay, so I felt it was important for a little bit of context leading into the 2023 first half outlook here. So how do you feel based on we've had a little bit of a surprise start to the year, I'd say, just as far as how much the NASDAQ has outperformed the Dow. Where do you think we go from here? What's the sequence possibly of events, and how does this kind of graduate throughout the next 6 months? No pressure.
Can you bring the crystal ball over here, Charles? So the old normal, it's the title of the first half outlook. Try to find something catchy that someone hasn't trademarked yet. We have 4,300 as kind of a target for the first half. How you get there because the economy doesn't go into recession, earnings don't fall as much as people expect. All those people who sold stocks at the end of the year have to turn around and say, hey, I'm missing out and I'm going to buy stocks. And you get the valuation just coming back up. What happened in 2022 was almost entirely valuation compression from real interest rates going up a bunch, the Fed trying to fight inflation. Those real interest rates are starting to come down, and that takes the whole multiple of the market up, and it takes the multiple of growth stocks up the most. So anything that has a terminal value way out in the future. You know, they're investing a lot of money, whether it's technology or biotech. Those stocks will go up the most, and it just so happens technology and services are still the most overweighted groups in the S&P 500. So, like those areas initially for the first half, you know, we're broadly diversified, so we still own staple stocks. Don't expect a lot out of those, you know, at the beginning of the year. Own industrial companies. There's a lot of money, whether you like it or not, in the Inflation Reduction Act for the industrial build out here domestically. And then there are other countries across the globe. There's a question from one of the viewers, you know, is there a way to invest in the rebuilding of Ukraine if and when the war over there ends? The answer is probably. You know, we own some construction type companies, equipment companies. They're steel companies. You know, Ukraine used to be a big steel operator. We don't own any steel companies currently, but you know, that's an interesting space. Industrial components for airplanes, just anything you can think of that we've underinvested in for 15 years, whether it's here in the United States or over in Europe, it's probably free game.
And you're talking specifically about the Inflation Reduction Act?
Domestically, the Inflation Reduction Act, you know, it targets semiconductor fabs here in the United States, roads and some infrastructure. So, but you know, Europe's going to have to rebuild a lot of energy infrastructure if they want to get away from relying on Russia.
Okay, so a lot to kind of unpack there. I want to bring it back to the real interest rate. I want to explain how that calculates into the overall stock market valuation. So going back to the concept of real interest rate. So if we look at, again, that's forward-looking inflation expectations. You subtract out, we're going to use the 2-year Treasury for this example to come up with what we call real interest rates. That is the interest rate that is used to discount expected future cash flows that a company will receive. So when I'm valuing a stock, I look at the next X amount of years of cash flows that that company will have. I'll discount it to the present value and then provide some type of multiple based on some type of formula. So again, when we're starting to look at this 4,300 as a rough target for the first half of this year, understanding that those real interest rates are coming down, how it's played a tremendously important role over the past 15 years in fueling growth stocks. It's also playing a role right now in this part. It always plays a role, but that's what we're kind of seeing right now in the beginning. And it's so data dependent. We are so data dependent right now. You see this morning with what the GDP print and then the CPE number that came out. So the market is starting to see some of these things transpire in the data, and that's giving investors a bit more confidence and more clarity as to where money should be allocated and how they feel, you know, the markets are going to perform short term.
The leading indicators, and Charles has already pointed out a couple of these that are favorites of his. One of them is services PMI. You know, you're not supposed to invest when services PMI is 60 or 65. That's when everything feels great. I think it was 46 this morning and just starting to tick up like 46.5, which is contraction territory, but getting better. And that's what you're looking at. You're looking for that marginal change, you know, or yeah, things look bad, but going from horrible to bad is good enough. You know, just like going from ecstatic to happy, that's generally is not going to work very well in the stock market.
Yeah. So, okay, let's say the low side. Let's say, what are some things that could happen that would cause that target to be missed? And on the downside, a range, possibly kind of a sensitivity analysis of if those things happen, where the market could be to the downside relative to our expectation.
Yeah. So, I mean, the biggest one that can be controlled is whatever the Fed does. You know, if Jerome Powell and the rest of the Fed board decides their reputation is at stake and they could care less about, you know, what's going on in the financial markets or how many jobs get lost, and they want to raise rates to 6%, the stock market will go below its old lows, right? It'll go below 3,600. You know, it'd go to 3,200, something like that. China invades Taiwan. Now, don't see that happening this year. Is it going to happen in the future? Unfortunately, my guess is the answer is yes, some years down the road. Russia breaks out a nuclear weapon. I can't predict that, right? We'll probably, if that happens, the market it might not open that day, which probably is the best thing for your portfolio, so you don't rush in and sell everything. I don't know, we go to 3,000 on the S&P if, the Russia pulls out a nuke. But those are unpredictable events. Those are black swan events. And there's a reason they're called black swan is because they're unpredictable. They're businesses that are run on that stuff. And
take out the black swan event type, the black swan type events. Let's say Fed raises rates 50 basis points this upcoming meeting, and maybe we get some bad inflation data over the next month or so. What I want to convey here is I want people to understand, without those black swan type events, what is the downside we believe, what do we feel the downside is in the short term, just based on maybe the Federal Reserve acting against how most people feel, or some type of bad inflation data?
We'd go back and retest the lows, 3,600, but so many people sold there, and so many people sold last year, and the Fed is trying to front load all of this because whether you believe them or not, they are a political animal, and they want to get all of this done as far in advance from the 2024 election, so they look like they're not helping out one party or the other.
So we today 4,100, I believe, on the S&P.
Short of it, 40.75.
Okay,
like that,
so let's call it 10 to 15% downside from here. If we see some bad inflation data, the Federal Reserve gets a little bit more aggressive than we anticipate. And on the upside, maybe let's call it 5 to 10% if things go swimmingly well over the next 6 months. Yeah. Okay, so I wanted to talk a little bit because we get these questions all the time, so I wanted to make sure we touched on this one. And I know it's something, Chris, you and I have talked about a lot over the years, but precious metals. So precious metals, are they part of the equation for managing inflation and poor stock market performance?
So selfless promotion, did a video on precious metals mid last year when I think they were being touted as inflation hedges. That they're always run out in the press that way. Gold and silver are not inflation hedges. If you can show me data that says they are, I will change my mind. But the data I've seen for the last 10, 20, 30, 40 years, they do not hedge inflation. If they did, gold would have been going straight up in 2022, right? It isn't. When has gold started going up? It started going up in October of last year when real interest rates peaked. And what else peaked in October of 2022? The dollar. So precious metals are a currency hedge. To me, they're not an inflation hedge. Gold worked great last year if you were in Japan, if you were holding it in yen terms. But in dollar terms, it didn't go down as much as stocks did, but it didn't hedge inflation, right? It can't hedge inflation because it doesn't pay you anything. It doesn't pay you a dividend. It can't raise prices. It sits there. It's pretty. It's a store of value against countries devaluing their currency.
Yeah. The argument was made for Bitcoin as well, that Bitcoin was an inflation hedge, and we saw, obviously, that was not true. Great theory, though. You have a limited supply of something. It could counter any inflationary acts by massive printing of dollars, but that turned out to not be the case in 2022. So, okay, so before we transition to bring Charles up here, what other kind of big topics when we look at, do you want to talk about kind of sectors and what we're looking to be in? Because again, we want to stay balanced. We're never going to say, we feel that cyclical stocks are where we should be, so we're going to put 100% into cyclical stocks. Again, we need to stay balanced because we're managing money with a focus on risk management just as much as we are on trying to achieve really good returns. I say this all the time to clients. If I could wave a magic wand and double the amount of money you have in your investment portfolio, it's probably not going to change your life. But if I wave that same magic wand and cut it in half, well, that will have a significant impact on your standard of living, on the way you sleep at night. So it's about risk management as much as it is trying to achieve really good returns as you get to retirement. But sectors of importance, maybe kind of tilting the portfolio in certain directions, kind of without giving away all the secret sauce.
Well, for new clients, right now the market is selling off stable companies, right? They're selling off utilities, they're selling off staples, they're selling off healthcare companies, because right now they're back chasing growth companies and cyclical companies. So for brand new clients, if you're near retirement age, we'll probably be gravitating towards the safer, more stable ones, because they're starting to come down in price. The dividend yields are going up. They're starting to look more attractive. Most of those should benefit down the road from a weaker dollar as well. It's just the market is starting to chase the cyclicals. We own cyclical stocks. We'll probably try to expand the number of names that we own in the cyclical area, industrial area. We do own some construction companies. We've owned them. We think we bought them back during COVID when no one wanted them. But we could own some other exposure in that area. May look around the international markets, just because if there is a peak dollar, we might want some more international exposure. We get it through a lot of our names, because a lot of these big multinational companies, whether they're technology or big construction companies, have huge international sales. But we might, with additional help from Charles and some other resources, try to look at some international leveraged markets. Maybe it's materials, steel companies or things like that.
So Vanguard just came out with their report, I think, this week, with their projection for U.S. equities over the next 10 years. I want to say it was around 4.7%, but it was a very, very small number. I saw it was kind of causing a little bit of some noise out there, I guess, in the internet.
So I didn't see that article, but one of the interesting things about 2022 was people keep talking about, are we in a recession? Did we have a recession? Are we going to have one? The average drawdown during a recession, I think, is about minus 35%, somewhere around there. That's the average bear market, minus 35%. If you look at the absolute peak to the trough in the S&P 500 from January of 2022 through October, the peak to trough was minus 28.5%, something like that on the S&P 500. Then you add in inflation, which at the time I think was about 7%, you get minus 35%, minus 35.5%. So we had the average bear market last year. No one's writing about it that way, but your portfolio, the amount of money you can spend got damaged in that fashion. Don't expect that to happen this year. The returns after years like last year are considerably better. That's why the outlook for the first half is what it is. The 60-40 portfolio, we did a podcast on that, a YouTube video. It's probably you can recommend it to more people than retirees, because the bonds are actually finally returning something. There's actually yield in the bond market. So.
I wanted to answer just a couple planning questions, and then we're going to bring Charles up. So I get this question all the time as well, and the first two real quick came from Dwayne and Val. I want to say thank you guys very much for those questions. This one came from Thomas. I'm going to leave your last name off, but should a portfolio makeup look different in a Roth IRA versus a traditional IRA? So these are financial planning questions that we don't get into specific detail about, but I will share that a lot of times when our clients have Roth IRAs, they are for longer term capital appreciation, and they don't plan on touching those funds. So sometimes the time horizon can change for those accounts. A lot of times they often are never anticipated to be withdrawn from while living. They're tools that are going to be passed on to the children. So I wanted to point that out, that in times where we do see volatility, I actually had a conversation today with a client. We can make those investments in what we deem more risky or more aggressive positions, possibly, if you have a very long time frame and can deal with the volatility. Because when those names are beaten down in times like this, if everything lines up with your goals, the time frame, we can own those types of companies inside the Roth IRA because we don't plan on touching them. And that's where, again, the marginal return on invested capital is at its most, is when companies are kind of beaten down.
Your highest marginal return on anything you put in the market will almost always come if you invest in the middle of a recession. If you have money laying around and you put it in the market in the middle of a recession and don't come back and look at it for 10 years, it will almost always be the highest percentage return that you return over any time period, because valuations are down, the economy's down, money's coming out of the market. But that's the time that you should put in your long-term money and kind of walk away. Can I answer one of these questions?
Yeah, please.
There's a question in here on what are our thoughts on real estate investment trusts, and it's part of our core four. So real estate investment trusts were a lousy asset class last year. They're one of the most interest rate sensitive assets out there, whether they're tower stocks, which are real estate investment stocks. Those are kind of the growth oriented ones. They got killed, but their businesses remain stable and growing. The real estate investment area is anti-inflationary. Is that a word? It is a sector that can combat inflation. The issue is their pricing power lags. So, inflation went up 7 or 8% last year. The stocks initially dropped because you're discounted cash flow. But behind the scenes, the apartment complex, the hotel, or whatever else is in the REIT, over time they are going to be raising their pricing. It just lags. They can't do it immediately and raise pricing on everyone. There are rental agreements and contract agreements and lease agreements that roll off over 1 year, 3 year, 5 years. So it's lagging, but they're definitely inflation hedges.
And they are a core part, no pun intended, of the core four strategy here. So yeah, we do see real estate investment trusts, real estate in general, as being a very viable asset class in retirement. And it falls in line with the retirement planning concept, where we want to see multiple streams of income from various places. As long as we can keep a diversified portfolio that's balanced, but also focused on your income needs, your tax situation, and have all these different pieces working together with one another. I know in a year like 2022, it may not feel like everything is working together, but when we build these plans and we account for these types of market downturns, this is why we have the reviews with you, our clients, so we can go through and help recommunicate to you why we have different things in the portfolio, what their role is, the overall income and tax strategy. So real estate, investment trusts, or rental real estate for that matter, if you like actually owning physical real estate that you manage yourself, or these days have a property manager manage it for 30% or so, can be a very viable asset class in retirement.
Yeah, behind Troy, behind Jessica, behind myself, there's a group of planners and essentially quants that stress test your retirement plan. And so as a portfolio manager, I might not be able to comprehend 2022 before it happens, right? I didn't live through 1937 or whatever the year was. So I can't comprehend the stock market being down 28% at one point in time and the bond market being also down 20% at the same time. But the software that we use behind the scenes does comprehend that and does run calculations. What if, the 1 in 1,000 event happens? So the retirement plans that Troy and the team put together are based, largely on those financial calculations, and they stress test it. Can I continue my retirement? Can I retire when I want to? If that 1 out of 1,000 events hit.
And it's about mixing different asset classes together that don't correlate together with one another. So correlation is when everything moves in the same direction. Having asset classes that move in opposite directions or stay neutral, don't lose when the market goes down, helps to reduce overall risk, in addition to contributing to income planning. Real quick, and Charles, I promise I'm going to bring you up right after this one. I've got a lot of questions from clients about a dividend portfolio. So we are big believers in dividend stocks. So ever since day one around here, dividend stocks have been a core component of the overall portfolio. What has happened over the past several years, while we've still included dividend stocks in portfolios, based on what the Federal Reserve was doing, we also started to include growth stocks to take advantage of those opportunities. But we are happy to announce that we will be introducing a portfolio specifically for those dividend and income investors very soon. So that is, and we do have clients that have that now, but at the same time, something that is, I think, more widely focused, and more widely available, and more narrowly focused.
Yep. I would caution viewers that don't expect this portfolio to pay a 7, 8, or 9% dividend, right? That you can probably find some financial advisor who will create that portfolio for you. I will advise you it is not sustainable, and your capital will be depreciating every year. The best case in point on a single stock,
probably.
well, yeah, or single stock wise, go look at AT&T and tell me that that company, I think it might yield 7 or 8% now, has been worth, holding on to for the last 20 years, whether it's paid you a dividend or not, because you're losing capital every year, and then they're paying you money, so you're getting taxed on it. The stock's going down. It's this treadmill of it's a bad company. And their dividend isn't sustainable at that rate, so we'll avoid that stuff. So the dividend might be, it's going to be lower, but hopefully it'll grow.
Because we still want both. We want dividends that pay out. We want dividends that have a history of increasing the amount they pay to you, but at the same time, we also want capital appreciation. Okay, so we're going to go ahead and bring Charles up. So before we bring Charles up, I want to go a little bit through his background. So Charles co-managed the $1 billion Van Kampen American Capital Emerging Growth Fund to a #1 Lipper ranking. Built and managed a $3.5 billion gross long-short equity mutual fund, focused on high risk-adjusted returns. Ended up launching a whole product suite from that first fund, all of them five-star ratings from Morningstar. Went on to run his own hedge fund and family office. Most recently was consulting for Price Waterhouse. And you've known Chris for a very long time, and Chris pulled me to the side and he said, Troy, with what's going on economically, what's going on in the markets, my good friend Charles may be open to joining the team and helping clients here achieve their retirement goals, open new product offerings, and improve efficiencies from an operational standpoint. Your experience really spans every aspect, really, of operations and investment management over the years. So we just wanted to bring you on to introduce you to our clients, but also give you and Chris a minute to kind of dialogue back and forth because you know each other so well, but also really just introduce you. And Charles, welcome to the Market Summit and Oak Harvest Financial Group.
Yeah, well, thank you so much. I can't begin to tell you how thrilled I am to be here at the firm, and very, very excited to be back working with Chris again. We have a lot of history together, and looking forward to what we're going to do together, and big believer in what we're doing here.
So one of the things, when you kind of go through your resume and everything you've accomplished, one of the things that sticks out to me is just the diverse background and asset classes and different economic environments. I guess just for maybe a little bit, kind of talk about what your experience has been working with institutional money and then retail money through all these different kind of economic cycles over the course of time.
Sure. I've been just so fortunate to be involved in this business and this industry at all, but to have worked across, many different asset classes that then serve so many different clients, it gives you a unique perspective. But the one lesson that I take away, and I'll almost give you the summary first, is that anytime you do this, what you have to do is you have to bring to bear a very disciplined process that allows you to create a framework that at least gives you the best opportunity to deliver good results. Doesn't mean, you actually have to do it, right? That sounds great, but you have to have the experience and understand what that process is. So if you take a step back and look at my background, I got started in fixed income research, right? I built the fixed income research department for what's now JP Morgan Asset Management that support, multi-billion-dollar corporate bond, municipal bond, money markets. Have done primary equity research, fundamental primary research, visiting companies, building earnings models, talking to managements, making recommendations to a committee. And then I had the opportunity then to join a mutual fund firm, which was Van Camp and American Capital, and that's where I met Chris. And I entered into then a more institutional environment that was very much quantitatively driven. They had devoted a lot of their resources towards data. How do you use data to drive an investment program? And I worked with a tremendously skilled fund manager. We ran that Van Camp and American Capital Emerging Growth Fund, which was a high growth, long only, small mid and large cap growth mutual fund. And you learn how to use these quantitative tools. And then after really good returns there, had the opportunity to go work for the crosstown rival, AIM Management, as one of the first outside fund manager hired there, and was given this challenge of then taking a $7.5 billion fund and seeing, what can you bring to bear there? And what it caused me to do is begin to think about this process, this whole idea of process. How do you meld fundamental research, quantitative research, and be able to scale it? And that's where we came up with this idea of a quantamental approach. How do I examine this massive amounts of data in a way that allows the portfolio manager to focus on what's most important, so that then you can spend your time then doing the fundamental work. And what we did is create this process-driven research program that allowed us to scale what we were doing. And then along the way, as we were building this team and realized the opportunity that we had to build and grow what we had, I got Chris to come back and move from the West Coast. He had gone off, he had left Van
and was working
on the West Coast, and I was able to convince him to, pick up his family, move back to Houston, and be part of this team. And it was just so vitally important to what I was doing and what we were trying to create. And so we took this process, and that's what allowed us to then develop additional products, long, short equity products. We developed these opportunities funds. Were one of the industry's first sort of hedged equity product. And it just helped us increase our skills, learn more about, work through numerous economic cycles. We went through the whole internet boom and bust. And we could, the experiences you got from doing something like that were just invaluable. And so when Chris ultimately left AIM or Invesco, and then I did as well, and then moved on. Let's just go to where I was working for another RIA, not dissimilar from Oak Harvest.
Before we jump there, real quick there, Charles. So when you came aboard, it was a $7.5 billion fund with a 2-star rating from Morningstar, and it sounds like through the process and implementation and execution of that process, 4 years later, $28 billion in assets and a 4-star rating, returning 24% a year.
Yeah, I would attribute that to developing the process, putting together the team, understanding what the goal is, right? And then bringing in, just as we're doing here now, bringing in the best possible players, explaining to them what the goal is, having the resources available to bring to bear on a process-driven, we call it institutionalized sort of approach, is the only way that you could scale something like that. That's what we did. And sort of just let's fast forward. Say, well, that opportunity exists today, right here. And the objective, and my objective, is to help bring that quantamental, process-driven approach to what we do. Everything that's been done so far with Chris and with James and yourself is phenomenal. But now is just the right time to bring to bear some additional resources and put in place process.
So I've talked to Charles ever since I think I came over here, and I think so when I came over, with James, I think when you hired James 6 years ago, I think you guys were 35 million in assets, something like that. I came over maybe 50 million. Now we're getting close to 600 million under assets, and myself, James, it's tough to manage money and have other things to do in the company. And I immediately thought of who is the best person I know at not only managing money but building teams and making the people on that team better. And I thought of Charles and gave him a call and said, hey, are you interested? And we've got him on board, and I'm happy as can be. We've worked together twice, parallel the first time. He was my boss the second time. Now we're on the same team with the same goals and objectives to help our clients here at Oak Harvest, help the performance of our current clients, create some new products for maybe some new clients, help you and Jessica grow the firm.
And that's always been my promise to you, our clients, to focus on the mission, which is to provide a world-class experience. And we're always hiring for the future. We're always hiring for where we think we will be. And Charles, very happy, very proud that you decided to join the firm. And obviously you have a lot of opportunity out there. And for me and our clients, I think it really speaks to the point of what we're doing here for clients and what the opportunities moving forward are. So very, very glad to have you here. And we look forward to having you on more involved in future. We do these monthly, more fun kind of market updates. We do them together here. But this is kind of more formal. We'll also do this in 6 months when we have the mid-year review and second half outlook for 2023. So we'll look forward to having you on those. Chris, any final thoughts about 2023 first half outlook or anything we didn't cover here that's important to convey?
I would just go watch the video. Click on the link at the end of this video. Watch it. I know it's a little long, but it does have graphs and charts. It's called the old normal because we're back in an economy that isn't going to be manipulated as much by the Federal Reserve like it's been since the great financial crisis. We will have economic cycles, right? I think Janet Yellen once said, we'll never have another economic cycle or crash. That's not true. We're going to have economic cycles. The training wheels are off, and it's time to grow the economy on its own, and it's going to be rocky. But we do have a positive outlook here for the first half. In this election cycle, it's normally the best year period for the markets is the third year of a presidential term. We're in it. So right now, we're actually progressing as a very normal election cycle seasonality.
And there are risk factors out there, though, and this is what we have been talking about for some time now with many of you one-on-one, is yes, we still do remain positive, but we also recognize the various directions that this could go based on the data, based on the Federal Reserve's actions. And coming off a year like 2022, where both stocks and bonds were down significantly, when you're in the retirement phase and you're pulling money out of your portfolio, that fact is not lost on us one bit. As a matter of fact, that's what we come to work every single day thinking about and working on, is understanding the risks that are so different when you are in retirement or soon to enter retirement, when you have a year like this where both stocks and bonds were down simultaneously, versus if you're in the accumulation phase and you don't need this money for 10 to 20 years. So we're acutely aware of how important this year is for you and your portfolio and your retirement. And although we remain positive, we do recognize that there are some risk factors out there. Everyone's individual portfolio is being adjusted based on your preferences, your goals, your objectives, and the discussions you've had with your advisor. So with that said, I would like to go ahead and close out tonight and thank you all very, very much for tuning in to the Oak Harvest First Half Outlook Summit. And we look forward to seeing you next month when we do this on a smaller scale, a little bit more fun. And then, of course, the mid-year review we'll do most likely sometime in July. So thank you very much for tuning in, and we look forward to seeing you soon.